Hello, this is Bob Steele. In this video, we will be discussing business income, which is reported on a Schedule C. So the objectives are, at the end of this, we will be able to describe how income and expenses are recorded and reported in terms of business income, of course, define and explain ordinary and necessary business expenses in terms of business income, define and calculate depreciation, define and discuss travel and entertainment expenses, define and explain the deductibility of a portion of a residence. And if we take a look at the tax equation in this case, you'll notice that we have gone down the tax equation starting with gross income, moving to deductions above the line or deductions for adjusted gross income to come to the AGI or adjusted gross income, then itemized deductions. We've kind of worked our way down here. And unfortunately, the tax code is not a perfect world in that we're going to have to bounce around a bit. So in this case, we're actually kind of going back up to the gross income. So when we talk about business income, the reality of the situation is we're going to be talking about business income and business expenses. The net income, basically the net of the business income, will be reported on the Schedule C, and that net piece will then carry over to the front page of the 1040. So when we look at our tax equation, really the Schedule C is going to be here in income, but it's going to be the net income that's going to be included in here. So really, this income line, as it relates to business income, is a bit deceiving because, of course, it includes both income and expenses, or in this case, both income and deductions, because expenses are in essence deductions. Okay, so first let's define a trade or business. So any activity that is engaged in for profit. And many people have different ideas about what income is, what a business is. And one, they worry about different types of businesses. Two, they worry about whether they've met all the regulations of a particular state in order to be in business, such as a business license and items like that. So let's address a few of those as we go into it. First, the idea that what do you have to do to create a business if you're going to be a small business? What you have to do is start generating revenue. You have to be in a goal of generating revenue. And from the IRS standpoint, obviously, the IRS sees themselves, you can think of them as your silent partner in some ways. So as soon as you started generating revenue, the IRS viewpoint is that's income and we deserve our portion as basically kind of like your silent partner. So in order to be a Schedule C, all you have to do is engage in something that generates revenue or engage in something that has the purpose of generating revenue. So there could be a difference between a hobby and a business. And a hobby really is an area where you may generate revenue, but your goal is not to generate revenue, and therefore you probably have a loss, which again the IRS is going to be very skeptical of. So if we're reporting losses, the IRS might question whether it is income or not. If we have income, then it's pretty safe that we can report it as income because the IRS is happy to take their share of it. Now, there's always a question of a business license and these ideas on the state and local level. Those are going to be state and local regulations. And notice those are different than the federal regulations. From the Fed, income tax purposes, they say if you generated revenue, you owe us a piece of it. From the state and local, you may have to have a business license. You may have to pay for a sales tax license and items like this. But even if you do not do that, even if those things are not set up, we're still a business and we still need to pay the taxes on the federal taxes. Even if it was an illegal business, such as Al Capone went to jail for not reporting income for basically tax evasion. And of course, he had an illegal business of selling alcohol at a time when it was prohibited. And of course, well, that's the assumption. And of course, even the illegal activity, the IRS says, hey, you made income, you should be paying us our portion of the income. So the idea that we're not totally in compliance does not put the situation where we don't have to report the taxes. So the other issue is what type of entity are we? And notice that we're going to be talking about a sole proprietor, meaning we just doing business and we're going to report it on the Schedule C. Later, as businesses grow, oftentimes they will want to incorporate or become an S corporation or become an LLC, a limited liability partnership. Those will have to file their own tax returns. Some of them may be pass-through entities. Some of them may have to pay taxes like a C corporation at the corporate level. For this lecture, we'll be talking about sole proprietors, meaning we have not done those things. We just started business. We're going to report it on our individual income tax return. We're going to report it with a Schedule C, which will be a separate schedule, which will basically be an income statement of the business, which will then flow over. The net income will flow over, as we discussed, to the 1040 first page of the tax return. So self-employed income is reported on the Schedule C. So business income, what is it? Gross receipts. And to define gross receipts, it's more clear in terms of a business. Obviously, anything that we received is business income. So the act of us performing services, anything that we received for that is going to be income. And that includes, of course, cash, includes checks, but it also includes things like if we bartered or something like that. Any services that we received for our work would then be reported as income on the Schedule C if we were business income. So individual contractors often receive a Form 1099 which reports income to the IRS. Now, this is something to point out because most of us were used to getting a W-2 at the end of the year if we work for somebody. We work for somebody, we get a W-2. What the W-2 means is that the person paying is also giving that W-2 to the IRS. So the IRS knows the income exactly that has been reported. It's our responsibility then to report that income on the 1040, but the IRS already has the information. If we don't report the W-2 on the 1040 at the end of the year, we're going to get a letter. We're going to get audited because the IRS knows for sure that we made that. How do they know? Because our employer sent the IRS a W-2. On a business, it's not so straightforward. If we work in a business and we work for a company, like we do contracting work for a company, so say we're a painter that paints industrial buildings or something like that, and all of our clients are basically companies and we're a sole proprietor, it's very likely that the companies would then at the end of the year be required to send us a 1099, which you can think of as similar to a W-2 in that they're going to say, we paid this individual this amount of money. We're going to report it both to the individual, but also that 1099 means, you know what we did too? We reported it to the IRS. Therefore, if your gross receipts that you report on the Schedule C are less than the amount of the added 1099s that were reported to the IRS, then it's likely that you'll get audited because that's an inconsistency. On the other hand, you may not get 1099 for all the work that we did. If we did the same, if we were the same painter, but we painted residential areas, residential houses, it's less likely that we're going to get 1099 because the individuals won't possibly give us the 1099 because they're not required to do that as an individual oftentimes. And so that being the case, that doesn't mean that you don't have to report the income. Any income that we receive for doing work should be reported. Of course, the IRS is trying to tie it down kind of like the W-2 as much as possible so that they could verify the gross receipts. So whether we receive a 1099 or not, we need to report whatever income we receive on the business income. If we do not report the amount equal or greater to the number of 1099s we received, we are likely to be audited. Okay, so let's see what else we have. We have cash or accrual method. So typically, just like any other tax area, we're typically going to be on the cash basis method many times for many small businesses for tax purposes. There's an exception to that rule. We're going to be on an accrual method, must be used if inventory is a material income producing factor. So the IRS basically said if your main source of income is inventory, then we're going to require you to be on an accrual method. Now, once again, what's the difference between tax and accrual? Why do we use accrual? We've learned accrual all the time for our accounting classes, and now we have a business and taxes, and the tax code is saying that we could use the cash basis method. Once again, the IRS thinks it's easier. It is easier in a lot of ways to try to audit someone on a cash basis method. If they reported so much income, or if they didn't report income, which is the IRS is more concerned with, the IRS could say, hey, you know, could you look at your checking account and see if these deposits are in there? It's more possible to track the cash. They can say, oh, you reported this many deductions. Could you show them coming out of the checking account. It's easier to track that. On the other hand, it can be easy to manipulate income with the cash basis method by paying more expenses in the current year, or by manipulating when the cash is going to be paid. So that's the pros and cons of the two methods. The accrual method, on the other hand, is more accurate in terms of what we have actually earned and not the cash we received. It's more accurate in terms of how the business actually did if the accrual method was done properly. But the accrual method being done properly, one, is a little bit more difficult to do, and two, it's a little bit more difficult for the IRS to audit that information. So just a quick definition of the two: the accrual basis method, accounting concepts based on two core principles are that the revenue recognition principle. This is going to be a timing difference for the most part. So revenue is recognized at the point in time when it is earned, not when cash is received. In other words, revenue is recognized when the service is substantially complete or when the goods have been delivered, whether we have received cash or not. So revenue is recognized when the work is basically done. When we've completed the work, we may have not received the cash at that time, but we're going to record the revenue at that time when we earned it. The matching principle is the expense side, same idea. Expenses are recognized at the point in time when an asset is consumed or liability is incurred in order to generate revenue at the same time period. Meaning, we're basically going to record the expense when we consumed it in order to achieve our goal. That goal for a business, of course, would be to generate revenue. On the cash basis, on the other hand, to contrast those two, revenue is recognized when cash is received and expense is recognized when cash is paid. Notice the simplicity of that. That's very simple way to put it, and it'd be a simple way to test and prove. You can just say, oh, I can prove that I received cash. I can prove that the cash went out. If we're depositing into the checking account, that's easy to prove. On the other hand, again, it's also easy to manipulate by delaying or enhancing the cash transaction and not having it line up to the actual work transaction is a way that then we can manipulate the revenue and the expenses on a cash basis method. So ordinary necessary business expenses. So in order to deduct business expenses, they must be ordinary and necessary. This is kind of like the general rule of accounting. So there's nothing very unusual about this. This should sound somewhat familiar to us with accounting, meaning that what is an expense? Those are the things that we needed to expend, to consume, in order to help us generate revenue in the same time period. So the general rule is that these types of expenses would make sense to us. If, for example, we sell cars and we sold a $50,000 car, it's unfair for the IRS to basically tax us on $50,000 revenue without taking into account the expense, mainly the cost of the car. If it cost $40,000 and we sold it for $50,000, it really only makes sense for the IRS to tax us on the net, the $10,000 net. Same idea goes for all necessary business expenses. If we needed the phone in order to do that, we should be able to deduct that because we needed the phone in order to generate the $50,000. If we needed utilities, if we needed to pay rent, those are all necessary business expenses which would go along with our general accounting principles. So ordinary means expenses must be customary or usual. Necessary means that expenses are appropriate and helpful to the production of revenue. And reasonable means expenses must be reasonable in amount and reasonable in relation to their purpose. So when we think about expenses, we have to think about it in terms of the IRS. And of course, for small businesses, unlike large businesses, notice large businesses often have a big incentive to try to look really good, because if they're publicly traded, they're trying to increase their value on the trading on the stock market. Small businesses often have the opposite incentive, because they may not care as much if they look good on paper, because the IRS, because they're not being publicly traded. And so, but if they were getting a loan, they'd want to look good on paper. But they may actually want to look bad for taxes, of course, because they want to pay less taxes. So the IRS is concerned, of course, with that. They're concerned that people are going to overwrite the expenses. So notice the tendency here on the IRS is to say that they want to make sure the expenses are reasonable, because they're afraid of people having a tendency to write off expenses that are not reasonable in relation to the business. So the focus, of course, when we're thinking of the IRS is the IRS is concerned with over-reporting of expenses. So forbidden expenses include bribes, kickbacks, and other illegal payments. So of course, anything that is illegal in terms of an expense can't be included as an expense. Notice it's kind of on the income side. We already stated that if you had illegal income, you're required to report it and pay taxes on it. But the illegal expenses, you're not required to deduct. So there's kind of obviously that that kind of is there. And then we have lobbying and political expenses. So these are not illegal, of course. Obviously, large companies spend a lot of money lobbying and influencing political laws if they can, because of course they want the political laws to somehow benefit them in some ways. But we don't want to get into a situation that government doesn't want to get to a situation where big business is has too much power. We're concerned with big business having too much power, so we don't want to encourage basically lobbying by giving a deduction for it. So businesses clearly lobby, but we're not going to allow it as a tax deduction. So fines and penalties. So this is obviously something else that we don't want to incentivize. We don't want people to intentionally take on fines because they get a tax deduction. This would obviously, the purpose of the fine is to stop behavior that the government deems as not good. Therefore, we don't want to lessen that penalty by basically giving a tax deduction for some type of fine. Depreciation. So we from the accounting classes, you'll remember that depreciation is applied to property, plant, and equipment or fixed assets. So the idea of a fixed asset, and this is going to be something that's on an accrual basis for the most part, whether the taxes are reported mostly on a cash basis or an accrual basis. So the assets are generally going to be on an accrual basis for tax purposes for the most part. And you'll recall that what depreciation is property, plant, and equipment includes like a building or cars, automobiles, and whatnot. And when we buy those things, we haven't yet used them to help generate revenue in the same time period. Therefore, they're an asset. So when we buy a forklift, let's say, if we bought it for $50,000 on a forklift, then of course we haven't yet used that forklift. So it's not an expense. It's an asset at the time of purchase. Then, because it's a long-lived item, let's say we're going to use the forklift for 5 years, we're going to have to depreciate that forklift over 5 years in some way, meaning we're going to have to allocate that $50,000 cost over the useful life of the forklift in order to expense at the same time period in which we generated revenue. So that's the concept of depreciation. In generally accepted accounting principles, we had straight line, we had double declining balance. The IRS code is going to be a bit more restrictive, meaning the IRS is going to tell us exactly how many years we can depreciate types of assets over, and they're going to give us a few options in terms of the type of depreciation we can use. Notice the tendency for depreciation is that we want to depreciate more in the first year than in the last year. So we probably want to not do the straight line depreciation for taxes. We want to do something like the double declining, an accelerated method. Why? Because that means that we're going to depreciate more in the first year, meaning we're going to get more of an expense or more of a deduction in terms of taxes, lowering our net income, and that will allow us to pay less taxes. So that's going to always be the idea. We'd rather get the deduction today than get it tomorrow for the most part because of the time value of money. We'd rather have money today than tomorrow because of inflation. So the basis is usually the cost. So the term of, if we have a tax term called basis, that's kind of like the cost. So if we bought the forklift for $50,000, that would be the basis of the forklift for the most part. Depreciation periods are determined by the tax code. So if we'll take a look at those depreciation periods, but the tax code is much more strict than generally accepted accounting principles. They just say, hey, these things fall into these codes, and that's how many years you have to depreciate it over. So depreciation convention is either half year, mid-quarter, or mid-month. So mini depreciation, let's just take the half year, are going to try to make it a little bit easier in terms of the partial year. So obviously, if we bought the forklift and we're going to depreciate it over 5 years, but we bought it on February 6th, then the question is, well, we didn't have it for the whole year in the first year because we only had it for, February 6th on. And the tax code, in order to make it easy, in order for us to not have this, random number of days ratio in terms of when we bought it, for much of the equipment, they'll use these conventions, such as the half year. We're going to say, hey, we bought it in the middle of the year. So take the full year divided by 2, and we're just going to say, I don't care when you bought it, I'll give you a half years of depreciation. You'll notice what that leads to, of course, is that if you tell someone that we're going to give you a whole half year depreciation, even though you bought it on December 31st, then a lot of companies bought a lot of stuff on December 31st and took a whole half year's depreciation when they only had it for like a day. And that's when the IRS came up with, for some purposes, for those types of assets, they came up with a mid-quarter and a mid-month convention to kind of disallow that. So, and the mid-quarter, mid-month, same idea, meaning we're going to assume we bought it at the middle of the quarter, or we assume we bought it at the middle of the month. So depreciation methods, double declining, 150% declining, balance, or straight line. So these are just kind of like to parallel the accounting methods. And remember that the easiest way to do it is the straight line, and we can usually elect to do that on many different types of assets. Elect to have just take the the $50,000 cost divided by the 5 years to depreciate it over. We could do that, but again, most of the time we're going to elect, if we can, to choose some kind of accelerated method. And what that will do will allow us to depreciate more in year 1 than year 5, allowing us to lower our taxes on the front end, getting a bigger refund at the front, or lowering our tax bill at the front end. Usually that's the case because of the time value of money. We want to do that. Typical depreciation periods. So again, the IRS code is just going to tell us what we have to depreciate. So 3-year property, if you got specialized tools, you have to depreciate it over 3 years. If you've got autos and computers, you have to depreciate it over 5 years. If you have furniture, fixture, and equipment, 7 years. If you have residential real property, obviously like a building and whatnot, that's going to be depreciated over a longer time period. Notice when we talk about a building, we're talking about the building, not the land. In this case, that's going to be depreciated over 27.5 years. If it's non-residential real property, it's 39 years. And notice that this is a long time to depreciate something over as compared to something like this. And because of that, there's a tendency to try, like if we bought a large building and it was going to be depreciated over 39 years, we could try to say, hey, parts of that building are really property, plant, and equipment. Like they might try to argue that the air conditioning and heating and air functions within the building aren't really part of the building. They're property, plant, and equipment, and we can depreciate those over 5 years. And so you can see some of the tax planning ideas here that clearly we want to depreciate earlier. If we can depreciate over 5 years, then we're going to get the acceleration of the depreciation rather than a 39-year property. So that's going to be the ideas for tax planning that taxpayers want to try to do. They generally will try to get more deductions in the current years than in the latter years because of the time value of money. Transportation and travel. So in order to qualify, it must be ordinary and necessary. Getting from one workplace to another workplace within a taxpayer's home area. So commuting is not usually tax deductible, but if you're doing something like going from one office to another office, or if you're doing something like going to clients' offices and whatnot, that could be deductible. Business travel away from home that requires an overnight stay. So travel as compared to transportation requires basically an overnight stay. So if we were going to go to a conference or something, that would be qualified for travel if we're going to stay there overnight. If that's the case, we could deduct things like meals and entertainment fully instead of having to deduct only half of the meals and entertainment. Now, of course, there's going to be a lot of questions when that happens because questions come up as to what if the travel is kind of partially a vacation? So we're going to go to a conference in Florida, but we're also going to visit Disney World. Well, clearly the Disney World isn't deductible. The conference is pretty much deductible. What about the flight and the room and board? And that's going to basically depend on, how much of the trip was for the work purpose versus the personal purpose. So that's one area that comes up a lot. Also, if we took a vacation for work purposes because we traveled to a conference but we stayed in extremely lavish conditions, then once again that would seem to be a personal type of item, and these are places where the line is fuzzy in terms of whether something is business or personal. And you can see that, of course, this is where taxes give people an incentive to, try to up their expenses. Obviously, the goal on taxes is to people have an incentive to inflate the expenses, and that's, of course, what the IRS is going to always limit on and question about. Deductible transportation and travel items. So automobile expenses. So obviously if we're talking about travel, it could well be that we're traveling within our auto. And if we're doing that, then we could save all the receipts and save the repairs and save the gas mileage and have a record of it. But if that's too tedious, we can kind of just average the miles. We can just track the miles that we're going to use and use a mileage rate method given to us by the IRS. So that's a more simplified method for the most part, which will allow us to calculate and deduct auto expenses. Travel, meals, and lodging for an overnight stay. So notice once again, the meals are fully deductible if it's an overnight stay, as opposed to if it's not an overnight stay and it's just meals and entertainment. So limitations if the trip is partially personal. Meals and entertainment are limited to 50% deduction if not part of an overnight stay. So once again, if we took clients out to dinner or something like that, then of course the meal is part of the business expense to a certain degree. But the IRS is saying, well, you would have eaten anyways, and now you're taking the people out to dinner, so we'll give you 50%. They kind of came up with just 50% of the meals and entertainment. And once again, that's another area that the IRS is going to be extremely skeptical on, because, if we take clients out and we all have a good time, then the IRS, there's a question as to whether it was actually a business purpose or it was a personal purpose. And of course, those two things are related, because the relation to clients is personal. You have a personal relation to the clients in order to do good business. So there's always going to be some gray area in that area. So business use of home. This is a huge deduction for small businesses a lot of the time. If we work out of our home, the question is, can we deduct the home, part of our home, either the rent or the mortgage, as well as the utilities and whatnot within the home? How much of that can we deduct? Can we deduct any of it at all? So the first thing we need to do is include a specific area of the home dedicated to the business. So, if we had a desk kind of in our bedroom, even if we did a lot of work at the desk in the bedroom, the IRS could most likely will say, you know what, that's not a specific area in your home designated to work, because, obviously you do other things in there. So, we're not going to allow that as a deduction. If, on the other hand, you have a separate office that's dedicated specifically to the business, then that office can then be measured and deducted. So then how would you go about that deduction? It also has to be obviously a regular part of the business in order to do that. For the taxpayers, and it has to be for the taxpayers' trade or business. Okay, so in order to determine that, if we had a separate area in our house that was for the trade or business and it was deductible, now we need to determine the amount to be deducted, because we may have things that are specifically for the business, and we may have things that are kind of for the business and the rest of the home, such as the utility bill and the rent and or the mortgage. So first, we could do this with a square footage type of ratio calculation. So we could determine the square footage used exclusively for business use, as well as the square footage for the house. So we could take the square footage of the use of business, as well as the square footage for the entire residence, and take the ratio, the amount for the business divided by the footage for the entire house, and take that ratio for the expenses that will be part of both the business and the house, such as the utility bill. So the utility bill, we can take that utility bill and apply that ratio. So if we have the direct business expenses, such as if we used a phone line that was specifically for business in the business office, clearly 100% of that phone line is deductible because it's for business. But if it's an indirect home expense, such as the utility and the rent or the mortgage, then we could use this ratio that we had here in order to see how much of these types of items would be deductible. So we are now able to describe how income and expenses are recorded and reported on the business income schedule. So you define and explain ordinary and necessary business expenses, define and calculate depreciation, define and discuss travel and entertainment expenses, define and explain the deductibility of a portion of a residence. Thank you.